Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
We just talked about strike selection. I prefer to use support and resistance to set my strike. It just makes more sense. And let's pick an iron condor here. So we'll sell the 31.33 put spread, and we'll sell the 38.40 call spread. And we'll do them both at the same time. So notice that the two options in the middle, the 33 put that I'm selling, the 38 call that I'm selling, they're more expensive than the ones I'm buying. So therefore, I take it in net credit. If I add up all those numbers, it comes out to 91 cents. So my maximum gain, because these are credit spreads, is 91 cents, my credit received. My maximum loss is the distance between either one of the wings. So the 31.33 put spread, that's a $2 spread, right? 31 to 33. So I say $2 minus 91 is $1.09. That's my max loss. So this is almost one-to-one. Remember I said I'd go as far as risking 3 to make 1? This is almost one-to-one. I risk 109 to make 91. It's not bad. And my break-evens here, as long as I stay between 32.09 and 38.91, I'm fine. So in this case, that's a pretty wide range. Now, let's see here. Oh, Jeff says, how much time are you giving these trades? 3 weeks to 2 months. Definitely no longer than 2 months. Are there screeners that find these opportunities, or are they too complicated? Michael, there are screeners that you can use to help find iron condors. The ones that I prefer are the ones that find implied volatility versus historical volatility. Make sure that implied volatility is at least 2 points above historical, but not more than 20 points above historical. But then once you go through that filter, then you got to look at the charts and see if it's in a channel. If it's not, maybe you just do a credit spread, not an iron condor, or maybe there's some other trade that makes more sense. So except for one that I built long ago and for a company, I don't even know where it is now. I have never seen one that looks for iron condors. I'm not saying that they don't exist, and like really go through all the important rules. I'm not saying they don't exist, but I don't know of any offhand. John says, what about support and resistance on Bollinger Bands? Some people who use Bollinger Bands, yeah, maybe you can use Bollinger Bands. I prefer just to draw some trend lines. Option trading can be very complicated. Some of my trades are very complicated. To that point, I like to start them all off as simple as possible. Don't get fancy. These trades can end up fancy really fast. Start out not trying to outsmart yourself. Draw some trend lines. If the stock always goes up to 80 and then retreats lower, 80 is resistance. If the stock, several times has gone down to 70 and then bounced off and went back higher, 70 is support. I don't think you need to get too much fancier than that. Michael says, makes sense. Support and resistance would be hard technically, yeah. average too. Yeah, I mean, you can use moving averages as well, but really, I mean, I just look for that price level where it bounces off, whether it bounces back up or bounces back down. And reason being, sometimes those coincide with Bollinger Bands or moving averages, but reason being is it's not like magic that it bounces off those prices. Those aren't like, special lines like, this like Elliott wave and Fibonacci numbers. I don't know, I shouldn't poo-poo those too much, but, those are kind of based on, I don't know, some sort of supernatural something or other, I guess, as I understand it, right? But I'm being a little bit sarcastic here. But regular support and resistance, those are based off reality. If you look at a chart and you see, oh, it gets down to 70 and then it goes back up. Well, look, a month back it went down to 70 and went back up too. Do you know why that happens? Because there are people who, like big institutions, who that's their buy level. They've determined the value of the company in their opinion, and they say, okay, if it goes down to 70, it's a value play, and we're going to scoop it up there. There's big-time buy orders sitting there. That's how those bounces happen. There's no magic. There's not like waves or like special numbers, multiples of 1.6 something or other. It's real life. It's an institution somewhere who has billions of dollars who are going to buy the crap out of that stock if it gets down to 70. So that's to me, that's real support and resistance. There's a person in an office somewhere with a lot of money supporting that stock at that level or resisting the stock at that level. So that's the kind of stuff that I like to use. How long do you expect to be in these trades? Bill, great question. How long do you expect to be in these trades? You got to hold them until probably pretty close to expiration. Why? Because they're theta plays. You profit from time passing. Jeff says, what if it's trading in an inclined channel, or for that matter, a decline channel? Great question. You kind of have to anticipate a little bit. You kind of have to draw those trend lines out a little bit in your head and think, do I think this channel is going to continue upward like this? And if you do, then adjust your strikes accordingly so that expiration coincides with the higher trend line prices. Awesome question. Patricia says, multiple contracts or one contract firing Condors? If you're brand new, one contract. Always start small when trading a new strategy. It's the best way to learn, because you're going to make mistakes. You're going to do silly stuff like, oh, I don't believe I did that. Oh, I'll never make that mistake again. And it happens to everybody. It happened to me when I was first learning. Would you rather make that mistake with one contract or on a 50 lot? Now, to be fair, there are some brokers who charge you a ticket charge. Like maybe you got to pay, $5 and then it's 50 cents a contract. That makes trading a one-lot, four-legged trade kind of oppressively expensive. You ask me if you're learning, I don't care. Pay the extra commission while you're learning, and then, once you get it down pat and you're confident that you can make money, then you step it up, and then that ticket charge doesn't matter so much anymore. John says, are the Greeks a cumulative number? Yes. You add up the delta, theta, and vega of each one of the trades, and you make, and add them together, like positives versus negatives, so you're adding some, subtracting some. It's cumulative, yes. There's a couple more questions before I get to them. I want to really quick just kind of point out a deal that I have going. Much of this presentation was about volatility. Every month I do a 4-part series. This month in June is all on volatility. I recorded this series and the series from the last 6 months, and I make these recorded presentations available to all people who, all my students who sign up for any one of these monthly series. July is what I'm signing people up for now. That's on mastering vertical spreads. We're talking about credit spreads here. Want to learn to trade credit spreads? Take this class. You want to learn how to use volatility to your advantage? If you sign up for this class, you get to watch the June class as well that has been recorded. You can watch it as many times as you want. Watch it at 2 o'clock in the morning when you can't sleep. So there's these 4 presentations plus the last 6 months. So that's another 24 presentations that have been recorded. One's on volatility, that's this month. One's on adjustments. One's on just income trades. You know, it's a very diverse set of topics designed for traders like you who have a thirst for this knowledge. I invite you to sign up for this class. You get those 4 presentations on Thursdays, plus 6 months of archives. That's 24 more presentations, plus all my trading tools, my online videos and tutorials. It's only $199. Now, if you make like 2 one-lot trades a month, you know, you have a $2,000 account, $200 is probably a lot. I would think would help you. It'd be a good investment, but it might be a lot. I mean, if you have like a $10,000 account and you make, you know, a good handful of 10-lot trades every month, $200, that's like your commissions for the month. It's nothing. I try to keep these classes very, very low cost because I'm in this to help people. I was a market maker for a really long time. I look at this as kind of giving back to the trading community while being able to cover my costs. So please, take advantage of this, really. And I'll tell you what, if you sign up for the July class, I'll even give you the rest of the June class. We're only halfway through for free. Just go to bit.ly/all caps DPJUN. Case sensitive. Now it's not .com, it's .ly. So it's bit.ly/capital D, capital P, capital J, capital U, capital N. Sign up today. It's only $199. I think you'll really, really like it. You get the whole month of July and even the rest of June. I'll throw in an extra couple of weeks for you. And the August class, by the way, yeah, the August class is, what is the August class? It's not vertical spreads. What is it? Well, here, I'll tell you what the vertical, or I'll tell you what the class is. It is, oh, time spread. Yeah, the August class is going to be time spread. So really, really awesome as well. And I even got a deal on there. If you think you're going to stick around for a while, you know, you can pay $1,000 for 6 months, and so you end up getting what is that? A week free, right? Or a month free, right? Yeah. Okay. Another question is the best to trade close to expiration? Oh, we already asked that, right? Yeah, you got to hold it so pretty close to expiration. I prefer to close it a little bit before that you get your risk off when there's like not really any reward left in the trade. My broker charges 4 commissions for the 4 options to build an iron condor. I know, Kent. Actually, that's the thing is like then when you know, once you're trading 5 lots and 10 lots, stuff like that, you'd probably rather have a ticket charge and pay a smaller per leg commission. I think a lot of brokers charge per leg. They all don't, I don't think, but I think a lot do. I got to tell you something though. When online brokers first started and like electronic exchange access first started, and before then, commissions were so ridiculously high that what I was paying as a market maker is about the same as what I pay as a retail trader right now. I mean, commissions are nothing, even if you're paying them on 4 legs. Especially, you know, I mean, if you're trading a real low-priced option like Ford, you know, you're selling some 20-cent options, stuff like that, it cuts in a little bit to your profits. But, I mean, it's not, I don't think it's a lot of money as far as a percentage of your trading. I mean, certainly if you're getting edge on your trades, it way overshadows commission consideration. Bob says, ideally this would require a mean reversion channel or a very slight slope. In the latter case, how would you adjust your length to your time? Yeah. In order to cap, well, you know what, Bob? Actually, no, not really. I'm trying to speak in general terms for, like, this benefit everybody. I think, Bob, it sounds like you know a little something about volatility. It actually doesn't require a mean reversion. You know, for the people who are new, listen, but this might be a little over your head for just a minute. What Bob and I are talking about here is this idea of selling high implied volatility and being able to make a little bit extra on every trade because of that. And I was saying, yeah, that if implied volatility falls to its normal expected level, you make money on Vega. That's called reversion to the mean. But that mean reversion doesn't have to take place in order for you to get edge, Bob, because if it doesn't fall, you are getting a higher rate of theta than you should based on your historical volatility. Somebody was asking before how Vega related to historical volatility. It's really theta that relates to historical volatility. Doesn't seem like it does, but it does. Because your theta is based on the price of your options. If you're selling options that are too expensive, you're getting too high of a theta for the amount of movement that's going on in the stock. So therefore, even if the mean reversion doesn't take place, you still get that mean reversion, but instead of getting in the form of Vega, you get it in the form of theta. So, okay. Newbies can take their earmuffs off, but people who are advanced probably have very wide eyes and are going, aha, I get it. And I hope that is the case, because now you're getting exactly how important getting edge is on these trades. So important. And guess what? Not only are we out of questions, we're also out of time. I must have timed it just perfectly. Sign up for my class, bit.ly/ all caps DPJUN. Sign up today. Really love to see you there. And also, you know, I mentioned that you can get volatility charts on ISE.com, and there's FXOptions.com that has lots and lots of trading resources. It's got Forex news and commentary, free Trade Alerts podcast, a trader forum, so you can talk with other traders. It's a really great resource. I've been on there a good number of times looking at stuff. It's fantastic. Thank you. If you have any questions, please email me, dan@marketticker.com. And you can follow me on Twitter. I have a Twitter presence. I like to talk to other traders on Twitter and give you a daily option tip. You can follow me at twitter.com/Dan_Passarelli. And we have one more question. Lawrence asks, Dan, can I sign up as well? Please remember, I am a complete newbie to any and all options. Lawrence, you should absolutely sign up, because if you sign up, you also get my basic level videos in the student section of my website to help get you started and get you primed for the weekly webinars. So yeah, even if you're a total complete newbie, absolutely sign up for sure. Okay, guys, thanks for attending. Thanks for the kind comments. Thanks for being you. I will see you next time. Bye.
All right. Thanks to Dan for sharing your insights today. Thanks to everyone for joining us also this afternoon. If you do want to learn more about the ISE FX options that Dan mentioned earlier, check out fxoptions.com. You'll see the full list of available currency pairs plus a whole bunch of other educational resources that are all available to
our webinar guests for free. We do hope to see you at the other upcoming webinars. If you want to sign up, make sure to visit ise.com/webinars. You'll be able to check out the latest schedule. Thanks again to everyone, and we hope to see you back next week.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.